Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hours show. Boy, oh boy, has the market fallen from going to the moon down back to Earth. The S&P 500 is below its key level. It's under its 200-day moving average. It has fallen. There is no momentum in the market right now. Only 18% of the S&P 500 is actually overbought. Everything else is down, and many are oversold. In oversold territory, the S&P 500 itself, the relative strength index is at a 23. 30 and below is oversold. That's where the S&P 500 sits right now. And the Nasdaq, well, that's even worse. So today, I want to talk about the market in greater detail. Not just an overview of what I saw in the market today, but actually talking about different mechanics in the market so we can understand what's going on. I also want to do a deep dive on Netflix, because that gives us a few clues as to what's to come as we are in full swing in earnings season. So, first, I want to talk about something I said yesterday in yesterday's live stream. I said the market is behaving in a bearish market mode right now. That certainly played out in the afternoon with a cascading dive that will likely have consequences for how willing people are to speculate on the long side of the market. Sentiment has soured relatively dramatically, with several measures now signaling real pessimism in the market. As a trading psychology note, just because you see big moves doesn't necessarily mean you have to trade aggressively. Stay patient, take a deep breath, and be selective in your trades and in your investments. Let easy setups come to you. Don't force them. A directional bias is not the same thing as a quality setup. Both are independent but necessary elements in catching a high conviction winning trade. So keep that in mind. Now, just a real quick plug. To help investors towards quality stocks in this rocky and tipsy-turvy market, we've put together the top 10 stocks list in categories volume, growth, dividend, and momentum. I know I say this every day, but I truly believe in these lists of stocks. And I am constantly updating these lists so you'll always have the best names available. So click the first link in the description or the link in the live chat to become a member and get instant access to our top 10 value, growth, dividend, and momentum stocks today. We've done the research so you don't have to. All right. Stocks turned sharply lower today amid disappointing earning results from companies that soared in the pandemic and as investors anticipate a tighter monetary policy. In the final hour of trading, the Dow Jones lost almost 400 points, and the S&P dropped 1.9%, sinking below this key technical level, well below its 50-day moving average, and now under that 200-day moving average. The Nasdaq plunged 2.7%, and it was the worst performer among the major averages, as growth stocks still underperformed and sharp losses in Netflix dragged tech stocks down. 10 of the 11 S&P 500 sectors closed in the red. Consumer staples was the only green. Now, for the year so far, 10 of the 11 S&P 500, excuse me, my thoughts are going too quickly. Deep breath. It's all good, right? 10 of the 11 S&P 500 sectors are in the red for 2022, led by, of course, technology, consumer discretionary, and real estate. Those sectors are down between 9.1% and 10.4%. The energy segment is the only bright spot, as that space is actually up 13.3% in 2022. Supporting the moves in energy stocks and energy ETFs is the rising price of oil. The S&P 500 is on track for its third consecutive weekly decline for the first time since September of 2020. Treasury yields fell, with the 10-year down 9 basis points to 1.75%. As investors and traders, we need to be patient and take a wait and see approach to this market. This market building up cash is important so we can buy stocks that are heavily discounted once the market finally finds its conviction again. Crypto got caught up in the fall too. It is also falling. Now, there is one meme that I saw that I thought was funny, and I thought I would share it with you guys today. And it was from Plan B over on Twitter. And the meme is this: how people think it's like to hodl when you're buying and you're holding for the long term. You think it's just riding a little trike bike down a kind of almost flat, level surface, right? Slowly going up a little bit. And then what it's actually like to hold as a long-term investor. You're going up a steep cliff. Then there's a big drop off. You got to climb over it like a monkey bars, right? And then there's a forest that you have to weave through. And then, oh my goodness, a big giant mountain that you either have to climb or somehow find a ride up. Then you get to the pond, the river, the stream, the lake, the bay, the sea, the ocean, right? And you have to cross it. Then you run into a fortress that you have to get through. And finally, you're almost there, and there's a valley, a deep and wide valley. Maybe it's in Arizona, maybe it's not, but you have to get across it some way or another. Then you're at the finish line. It's true. This is how the market works. It's not a straight line up and to the right. So thank you, Plan B. I appreciate the meme. I found it quite hilarious in our market that we are in today. Now, Bitcoin has fallen hard, is an understatement. BTC USD on TradingView, and there is a link in the description below for a free account. Bitcoin right now is at 36,350. Last night, after the live stream ended, Bitcoin fell. We put this yellow box here to see if Bitcoin was going to consolidate and move sideways. I still have the death cross circled that happened back on the 14th of January. And this time, with the death cross, what I said was it's a lagging indicator. It means we've already been falling, and we've either already seen the bottom or the bottom is near. And it looks like the bottom is near. Bitcoin falling to 36,000 is definitely below key areas of support. The $39,000 to $40,000 level, that was a key area of support. It fell right through it. Right now, the volume candle is higher than the actual candle here on the chart. Volume today. Let me move this out of the way so I can see the actual number. Volume today, 43.7 million, when the average volume is 16.8 million. Either people are getting nervous and they are selling quick without thinking about it. Oh my goodness, it's falling. Sell, 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 sell. Or it's everyone's stop loss being triggered like an avalanche or a snowball. Let me move volume here for a moment so we can see the candles a little bit better. To me, I'm not freaking out about this. Not at all. Because what I see is I see a discount. I see this big red candle down nearly 11% as a buying opportunity. Now, for the past couple of weeks, as the market has been convictionless and has been falling little by little and then a lot, dollar cost average is very important. Very important. You don't want to go all in at a specific point. You want to go little by little in a falling market like this. And one that is falling really fast, that's where you just need to sit on the sideline, make sure you're building up that cash reserve. So when the time comes that the market does show some conviction, you are ready with cash to go shopping, to buy these discounts. And dollar cost averaging is the best way to go because we cannot time the market. We have no idea when the bottom will actually set in. Now, with Bitcoin falling so fast like this today, over 10%, it's got to be more than just people emotionally selling. I haven't sold a bit, not one bit, but I have been buying, and I've been buying for a couple weeks now, little by little, dollar cost averaging. Now we are at 36. We're about to go to 35,000 right now. It is falling quick. Oh, it's paused here at 36,000 even. There we go. 35,700, 35,800 right now. Now we're in the 35s. How much further is Bitcoin going to go? I can remember being on a live stream when Bitcoin was hitting 69,000, new high, new high, new high, all the excitement. And now there's a lot of panic. But don't panic. Even if the economy is doing really rough, if cryptocurrency is falling, one of the rules that I think goes out to new investors is to never invest what you can't lose or what you can't afford to lose. And that's a good little saying for new investors. But for investors who have been in the market for a while, you've got a lot to lose. And you have to be careful. And emotion, it can really hurt you in a time like this. 35.7. I just saw 35.6. Ethereum is no better. ETHUSD on Trading View. And it's down 25.21 right now. It's also got a great big old red candle here. Now, this is odd, but remember back here when it was on this trend line and I said, well, Ethereum isn't as bad off as Bitcoin, technically, because Ethereum still has another trend line that it could fall to, and boy, oh boy, has it. Right now, the next area of support for Ethereum comes in at 24.25. That's the next area where Ethereum has some support. And right now, it's in a free fall. And it could get to that support area. And it's right now, both Bitcoin and Ethereum, they are pushing their way down. There's not a huge wick at the bottom of these candles because they're still finding the bottom right now. Let's check in on Cardano, ADA, USD on Trading View. And it's to $1.10. So this big rally that Cardano had in the middle of January here has been wiped out. We're almost to that low that was made back here on the 10th of January that kicked off that rally. So if we open this up a little bit here, that area of support is at $1.05 for Cardano. And I have a range here, $1.05 to $1.15 for Cardano. But it's down too. It's down 12.2%. It's like everything in crypto right now is down double digits. Okay. We'll come back to Bitcoin and check on it in just a little bit, but I do want to talk about one of the companies that I was watching for earnings today, and that was Ally Financial. The ticker symbol is ALLY. Ally Financial. So they had their Q4 earnings today, and it showed that their EPS was $2.02, and that beat by 5 cents on revenue of $2.2 billion. And that was a 10% year-over-year gain, and that beat estimates by $130 million. Now, the big standout in that earnings report was consumer auto finance. That came in at $10.9 billion. And that was a 20% year-over-year gain. That was a real highlight for Ally Financial and their results today. Now, they had good results. Their earnings were solid. It wasn't as bad as like JP Morgan or Citigroup. It wasn't as bad as them, but it was pretty good. But the stock has reacted. It was down 3.9%, call it 4% on the day, 47.05. Now, it broke below its 50-day moving average, just like many stocks in the market are below that critical area of strength, right, and support. So it's now back to levels last seen in December. So not too terribly bad. Financials have been doing okay. All right, let's talk about the market here. I'm going to go back SPX, which is the S&P 500, and I want to talk about some different mechanics in the market. Right now on the S&P 500, it has fallen out of its channel 4 days. Boom, 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 boom. Now it's below this critical level, this 200-day moving average. And if we measure, and we talked about this a few days ago, about how far could this correction actually go? And if we go from that peak right there, which was an all-time high, and we go to where we are at the close of today, I want to line that up as close and be as accurate as possible. That's an 1.67% pullback. That's not quite correction territory yet. You got to get to double digits, 10%. That's like the magic number to be considered in a correction. So the S&P 500, it's got more to go. It's going lower. Without conviction or momentum in the market, there's not much stability left in the market. Short-term or younger investors, newer investors, they see this and they get nervous. Think about new investors that came in the market in 2020. They haven't seen a big market correction yet. This will be their very first market correction that they've been in. Because for nearly 2 years, the S&P 500 has been in a trading channel, ascending up and to the right. Look at this. As I go out on the chart, the last time the S&P 500 was down below its 200-day moving average, well, it happened in the February, March, April of 2020, where we had this big V shape down here, right? Where the bottom just fell out of the market. That was at the beginning of the pandemic. Nobody knew what was going to go on, what was going to happen. That was the last time the S&P 500 has been below its 200-day moving average. So anybody getting in the market, let's call it right here, the last time it touched the 200-day, the 26th of June, 2020. Anybody who has just entered the market from June 2020 until January 2022 has never seen a big correction in the market for definitely a year and a half from that point. Nearly 2 years since the big fall here that started in February. So with all these new investors never seeing a correction like this, it's a shock. They're not sure what's going on. How is this happening? But if you've been in the market for a while, you know this can happen because right before the February, then March really bottom of the market, the last time it occurred was in 2018. December of 2018 was the bottom of this correction. And like I did before, let's measure it. We're going to go from the top here all the way down to the bottom. The box is in my way, so I have to go over here to line it up. All right, to the bottom. That was a 20% pullback. 20%, and we are only at 8.5% right now. We're only off the highs by 8.5% right now, and this pullback in 2018 was a 20% drop. So this can go a lot further. We could just be in the very beginning of a market correction right now. And I don't want to sound doom and gloom. It's just reality. So looking at this, I mean, this from March 2020 to where we are today, That was a very fast climb. No major corrections at all. We came we came close to breaking out of the channel back here in October of 21, but we didn't. So this 20% drop right here in 2018, that was the last correction if we look at March 2020 as a anomaly, right? So the major indices, they have all given up their 50-day moving averages at this point, which puts the market in more of a defensive or concerned state of mind. Any position that is underperforming is often cut from portfolios, and various hedging strategies are deployed on remaining longs. You want to protect those gains. Volatility has been on the rise as usual when sellers start to rush for the exits. And it's usually the newer investors who are rushing through that door first. Traders who fail to adjust their risk and approach when volatility rises has a higher probability of struggling with it. Overall, the market is looking like it's going a little too fast, a little too far to the downside as various sediment and breadth indicators start to read oversold extremes. So, while keeping losses under control is first on the agenda, investors should be making a list of stocks to pounce on when signs of a reversal or bounce gets underway. And not just these whimsical little rallies that we have had over the past this year so far. You want to wait for a solid bounce. You want to look for, and let's look right here at 2018 to see what to look for. What signs are we looking for that shows, I'm going to blow it up here a little bit, that shows us that the market is finally turning around, that we're not seeing a convictionless bounce in the market anymore, but a true rally is about to occur. Well, number one, once we hit bottom, because it happens, look at this, it's just like right now. Little by little, look at this, a 0.5% down, 0.02% down, 1.9%, 2.08%, 0.01%, and then 1.54%, 1.58%, 2.06%, 2.71%. So it happens little by little and then boom, all at once. That's the way down. And that's what's happening right now. And again, this was a 20% correction in the S&P 500. 20%, while we're only at 8.5% right now. So what we want to see is a strong bounce. This was nearly a 5% turnaround. And then 0.8%. And then there was a red day. Caution, down 0.12%. Then 0.8%, 0.1%. Then we had another red day of 2.4% because people got nervous. We've been rallying now for a few days. What's going to happen? Is this it? So some sell real quick, right? And then we get a 3.4% because once it hits bottom, it bounces back quickly. I don't know how that happened. Once you hit the bottom, then it bounces back quickly, 3.4%. And then you're in the rally. So you want to see a big, strong bounce. And then you want to see a retest, right? So if we look here on the second day of this recovery, on the second day, it started down here at 24.42. And then when we had this pullback, it came down to 24.43. So it's kind of like you're bouncing out of it, right? Big bounce out. And then to get that next big bounce, the springs coil up as you come down. You want to see that back test. And then you want another big bounce off of it. That's the sign we're looking for. Big bounce, right? And then we want to see a pullback, but not too far. No further than maybe in this example, it didn't pull back any further than where it opened on the second day of the rebound. And then another big bounce. So these are the key signs that we're looking for after the correction is over. How's it going, Mario? Glad to see you. So again, 20% correction here in 2018. Here's the signs that we were looking for now. And we're only at 8.5% now. So we could fall another 10%, which would put us at 18.5. We could fall another 12%. So if it's a correction like 2018, we're not even halfway done with the correction yet. But these are the signs that we're looking for. Now, let's do a little intermarket analysis. First, let's look at transports. Now, that ticker symbol in TradingView is IYT. Now, that's the iShares Trust U.S. Transportation ETF. Let's let that load. I got to adjust the chart here because we were in 2018. We didn't get to where we are right now. Back to today. All right. Oh, went too far. Okay, now you can clearly see we had a double top here in transportation. We had the top November the 8th, and then the top right here on January the 5th. That's our double top. Now we're below the 200-day moving average. We got close to the November lows of 254, but not quite. It got as low as 255. Now, it's well below that key area of the 50-day moving average. So it's in a bearish structure. Now, the 50-day moving average, it's below it, and it's challenging the December 20th bullish gap zone. And that was near $260. That bullish gap zone right here. Okay? This gap that you see here to the 200-day. We're below that now. All right. Let's look at the 10-year yield. And the way you can do that on TradingView is with the ticker symbol TNX. And that pulls up the 10-year Treasury note yield. All right. So here it is, right? It's in an uptrend. It's been in an uptrend. But something interesting here. Now, this uptrend, on the right side of the chart, it is pulling back after stalling along the 1.85% this week. Okay? There was this gap down right here, and it stalled right here at about 1.85%. And now it's coming back down to this range right here to try to find support. Because this was a quick move up right here over the past couple of weeks. Now, this area, the support, this range it's looking for, it's got a low of 1.69, and the top of it is 1.78, and it's at 1.746 right now. I mean, it actually dropped 7% today. That's pretty far. Okay, let's look at the strength of the US dollar. All right, and to do that in TradingView, you type in US dollar. All right, and that will get you to the Dow Jones FXCM dollar index, or you can use the next one down below. Either one works. Let that load there for you. All right. I need to go to the other one. I forgot I left my my drawings in that one. Okay, there we go. All right, so the dollar has been in this uptrend. It's in this trading channel, right? It right now had a pretty big fall right here on January 12th, okay? Now, it has bounced back after that hard fall, but it is breaking down under the weekly support, under the 50-day moving average. The 21-day moving average right here is really acting as support, as a temporary resistance level for buyers to battle over, right? Okay, so that's the dollar. It's rising, it's gaining strength. Let's look at oil, because that has been the reasoning behind the energy sector doing so well this year and being the top sector of this year. So to look at that, just type in US oil on the chart, and you're going to use the WTI crude oil for this one. Now, the crude oil, it continues to rise, and you look at this rally it's been in. Going back to the breakout of the symmetrical triangle on the 21st of December, and it's been on a very steep rally. Currently, it's back up to the October-November highs that were seen right here at the very top of this symmetrical triangle at around $85 a barrel. It's at $84.76 right now. The next stop, I believe, is $90 to $91. Now, to look at that, we've got to pull this chart down so we can get there, right? And what I'm going to do is I'm going to go up here to $90, and I'm going to put a red line there. That's where I think it's going. I think it's going to find an area of support right around where it's at now, 83, 85, and then it's going to bounce. And I think this rally continues all the way up to $90, $91, taking it to a multi-year high. You have to go all the way back to 2013, 2014 to see that level. And this is per barrel. $100 per barrel, it's not that far off. Looking at this rally right here, it's very strong. Okay, a lot of mechanics here in the market we're checking out. Let's go look at gold, all right? And to do that, you in TradingView, just type in gold, G-O-L-D. And you're using this US by ounce, and it's a TVC, and there's data's coming from TradingView itself. That's the one that you want to use. Now, gold finally captures a bid to break above a multi-week resistance right around 1830 an ounce. And it's at 1834 right now. And that was down 0.2% today. Okay. So gold has been on a rally here since December 15th. It ran up, but then it had a really hard pullback. It hit resistance right there at 1830, that 1830 mark. But then it bounced, and it bounced back really good. And now look at it. It is using that 1830 that was resistance here. It's now support right now. It's using 1830 as support. And that happens a lot when you're charting and looking at technical analysis on all kinds of different equities, whether it's stocks, whether it's gold or crypto. It doesn't matter what you're looking at. A stock chart, a crypto chart, a gold chart, whatever it may be, they all function in a very similar way. I mean, look at this big run up here in gold in the middle of November, right? This was a big rally. It peaked up here at, what was this, 1877, and then it fell hard. I mean, that's something typical of the crypto market, right? All right, so gold is up here. It's finding support at 1830, and it's in an uptrend, and it's moving. I think it continues to go up. And if we just go back and look at a bigger view of this, gold's been consolidating for a while. Here, I need to fix the chart. All right, now let's do that. Gold's been consolidating. You can see that. It's been moving sideways. There's been a couple humps and bumps along the way. But really going back to right around June of 21 is where it started to move sideways. After a big fall from a big rally, it had been declining since August of 2020. Gold had been on the way down, which you would think with inflation getting higher and higher and higher, that gold would be performing a little better than it is right now, but it's not. It's moving sideways. And just recently, going back to December 16th, is when it really started to rally and move up and to the right instead of just moving to the right. All right, so there's gold. It's finding a bit of support. It's moving slowly. 0.2, it was down today. It's moving slow, but it is moving up. All right, how about some market sentiment? And there's two places that I like to look to see how investors feel about the market. The first place is obviously the VIX, right? The Fear and Greed Index. VIX on TradingView, and it's the volatility. S&P 500 is what you want to look at. You also have the CBOE volatility index. You can use that one as well. I've got my drawings here in the S&P 500 one. Bitcoin Fear and Greed Index at extreme fear. Yes, it is. Yes, it is. All right. So if we, okay, let me back up here. If we look at this, right, 20, 20. That's about the average. Going back here to about April of 2021 to today. 20 has been about average. But if we look at this, look back here at the March 2020 drop in the market. The VIX, it spiked really, really hard, getting up to levels not seen in a long time. So if I open this up here, look at that steep climb that it has been on over the past few days. It nearly matches the steep climb that we saw back in December of 21, just not even a month ago, right? So the VIX reading about 20 seems to be the favor, a risk off bearish approach to markets anytime it's above 20. On the rise this week over 25, it's reflecting the higher volatility as stocks widen their ranges on weakness. So up over 25, that's when you start to see real fear in the market. That's what this has shown us. If you're under 20, that's when you start to see risk on in the market. So just like I was explaining with the 2018 20% drop in the market, that correction, and what signs are we looking for in the market to show that, hey, maybe we've got a rebound coming. Maybe the market sentiment is starting to change and going from risk off to risk on. We need to see the VIX below 20. Below 20. Now, if I go back just a little bit here, there is a support area, and it's down here around 15. And I'm going to put a line here at 15. Change that color because it's not negative, it's positive. So if the VIX can get all the way down here, all the way down to a 15, that is when growth stocks will start performing again. We get below 20, and that's when you start to see sentiment in the market shifting, going to more risk on. 15, that's the growth stocks. That's when you start seeing growth stocks take off again. So these are the two numbers that you're watching for on the VIX in combination with everything else we've looked at so far. Okay? So we have these like little check boxes that we need to check off to show whether we are in still a a a bearish market, right? A bearish turn in the market versus are we getting a bounce back? So for the VIX, we got to get below 20 and we got to get down to 15 if we want to see those growth stocks start growing again. All right. Now, my overall theme for the market this year, it hasn't changed. I knew a correction was coming, but I couldn't predict it. I didn't know when it was going to happen. But it was way overdue. And remember, on the S&P 500 right now, we're only down about 8.5% from highs. And the 2018 correction was a 20% drop. So we still have some room to go. All right, the next mechanic that I'd like to look at is the put-call ratio. Now on TradingView, you can do it with the ticker symbol PC for put call, and then EX. And this is the put call ratio. Okay. Now, it's kind of hard to look at here, so I'll do some explaining. It kind of moves sideways. You don't really have rallies, or you don't have that type of stuff here. It's really just ping pong, going back and forth like a ping pong ball, right? Okay, so the put call ratio, it's treated the 0.8 level as its new neutral zone, is what I'll call it, which is this blue line right here. Now, it's treated this as a neutral zone now for over a year. Rarely does it get to 1.0. So, right now, it's at 1.06. 1.06. It hardly ever gets to this point. So, what this shows is that there may still be some strength in the market. Now, a big jump over 1 has signaled a buy the dip opportunity for over a year and a half now. For over a year and a half. Drops below 0.8 have hinted at a strong market. So keep that in mind. When it's been over 1.0, that has signaled a buy the dip. And it's been that way for over a year and a half. Look, if we go back a year and a half before the March. Let me take the anomaly out of there, right there. Okay. So whenever we've gotten over 1, and it's really only happened, okay, so it got there 24th of July in 2020. It barely crossed over there September 4th, 2020. So 1, 2, 3, touched it there. I won't count it. So 3 times, 4 times, 5, 6, 7. So 7 times in the past year and a half, it has crossed 1.0. And whenever doing so, that for the past year and a half has signaled a buy the dip. I don't think that's happening this time. Now, when it gets to a 0.8, that has signaled a strong market, right? Okay. So that's the put call ratio. I don't think we are in a buy the dip just yet, because anytime looking at other indicators, anytime you are seeing what looks to be a buy the dip mentality, it fades away in the afternoon. It may start out as a buy the dip in the morning and then just come right back down in the afternoon, or vice versa. In the morning, it starts out down and ends the day buying the dip. Or maybe in the last hour, and then it sells off. So there's no buying the dip just yet. But what there is slowly dollar cost averaging as we're going down. No full positions. Do not open up a full position, because you don't know how far this is going to go. You don't know how far this correction is going to be. When I go back to the S&P 500, SPX is the ticker symbol. Okay? We are now below that 200-day moving average. that has not happened since March 2020. And quite frankly, it hasn't happened. If we take out March 2020 as an anomaly, it hasn't happened since back here, December of 2018. December of 2018 up to January 2020, ignoring the anomaly of the pandemic in March of 2020 and the big fall. But from December 2018 to January 2022, it has been a really good and really strong and healthy market. I know I'm ignoring the anomaly. I know that was a big drop, but this was a 20% pullback here right above my head in December of 2018, and we're only at 8.5% of a pullback right now. So we still have a ways that we could go. And if you want to just compare here, I'm going to measure the 2018 pullback from the 200-day moving average to the absolute bottom right here was 14% below the 200-day moving average. Okay, so let's go to today. And if we're here at the 200-day moving average and we drop down that far, wow, that looks pretty scary, doesn't it? How's it going, Devin? Just checking in, not buying the dip yet, still working off that last dip. Yeah, I think the main theme of today's video is to stay calm, stay patient, wait for a true sign that a reversal has happened. I think this could be a big correction. I think if we compare the last correction, which was 2018, right here, this was a 20% correction here in 2018. And right now, we are only about 8.5% off the highs. I'm guessing Wednesday night, be decent if J Powell plays nice. I'll probably start buying again if that goes well. Yeah. Yeah. All right. So there's that. We broke down a whole bunch of different mechanics of the market. That's where we stand. So there's a lot of bearish signals out there. There is no signal that I have seen yet that signals we are at a bottom. Bitcoin crypto market is in this same fall right now as the overall market. More and more, where are we now? Oh, we've pulled back some. Okay. So we were down here at the start of the live stream, 35,600. It got to 35,400, and now it's there's some dip buying going on right now. But my method right now is to just dollar cost average, little nibble, while it's on its way down, to help lower any cost basis that you may have. That's what I'm doing anyways. So, okay. I do want to dive into Netflix. There was some interesting stuff in the earnings report itself. So NFLX is the ticker symbol. Now, reading through the transcript yesterday, there could be some interesting developments for other companies as well. Just give me a quick second here. All right. Okay. So, Netflix, obviously, very bad, terrible, awful, bad day for Netflix. A huge gap down. I mean, a huge gap down. Over 20%, nearly 22% today. I know most of that happened in the after hours yesterday when we were looking at it, but Netflix is crushing today. After the TV and movie streaming company missed its global streaming paid net ads guidance for Q4. The company added just 8.28 million in the quarter, and that was below its 8.5 million forecast, marking its worst net ads in any fourth quarter since 2017. The company guided to I can't believe I'm about to say this, but only a 2.5 million net ads for next quarter in Q1. As a result, many investors are calling it the end for the FANG stocks. In Q4, Netflix smashed earnings estimates, posting earnings of $1.33 per share. The beat included a sizable unrealized gain from FX remeasurement, which slightly dampens it. However, operating margins of 8.2% easily topped Netflix prior guidance of 6.5%. So even without the FX gain, Netflix appears to have still beaten on EPS. As was the case last quarter, revenue was basically in line with estimates. It did jump 16% year over year to 7.7 billion due to FX and content release fluctuations. EPS and revenues are not scrutinized the same way as Netflix other metrics. So, even though Netflix expects EPS of just $2.86 and revenue growth of only 10.3% year over year to 7.9 billion in Q1, both of which are below estimates, I think subscriber growth, both domestically and abroad, primarily movies, primarily those move the stock. The EPS, the revenue numbers, margin, it doesn't move the stock like subscriber growth does. And I said that yesterday. As a result of this, Netflix 8.28 million paid net additions in Q4. Well, that came in below expectations by 2.6%. And that was enough to spook investors, especially when coupled with Netflix's disappointing net ads guidance of just 2.5 million for Q1. Netflix did not do much to put water out or put water on the fire either, noting that it is tough to pinpoint why its net ads are not bouncing back to pre-pandemic levels. The company did, I guess, maybe help to, I don't know. I don't know. It's just Disney Plus, right? It's a fierce competitor from Disney. Disney, through its Hulu offering and then Amazon, They could be stealing subscribers by commenting that its sustained engagement and retention numbers, they do not point to a material competitive impact. In fact, Netflix stated that growth by competitive services only validates the positive trends in streaming over the years. It was kind of encouraging to see that the EMEA region led net additions in Q4. It was up 3.5 million. Also, the US and Canada region, it was up 1.19 million net adds, and it was the largest since Q2 of 2020. The average revenue per user, or ARPU, that also continued to climb in the US and Canada region, going to $14.78, a jump of 9.4% year over year and just over half a percent quarter over quarter. Now, a rough patch stemmed from India, which is included in the company's APAC region, where ARPU fell year over year and quarter over quarter. While Netflix is raising its membership prices about 11% globally, it is lowering its price in India, sparking concerns that the company may be hitting the ceiling on its ability to attract more subscribers. Something else I said yesterday. Netflix does have, or Netflix does have to compete with a radically lower price for pay TV in the area in India. They roughly pay about $3 a month in India, quite the difference from US, which could be fueling the price drop. Maybe. Bottom line on Netflix, the pronounced slowdown in global streaming paid net additions, both as realized in Q4 and as expected in Q1, is a significant letdown for the streaming giant. Matters are not helped by Netflix's relatively rich valuation of 35 times fiscal year 22 earnings. Although the massive drop in the share price today makes the valuation more attractive than the 39 times multiple at which it traded yesterday, it still looks rather steep. Even though Netflix rival Disney and Amazon do not trade at much better valuations, 34 and then 57 for Amazon. Now, the companies are also more diversified in their revenue streams over Netflix. Just think of all the different things Amazon does besides its streaming service. And then Disney too. All the different things Disney does that Netflix doesn't. So, while Amazon hit a 52-week low today, partially, I guess, due or mostly due to Netflix, Disney also got to a low today, presumably because of Netflix. Netflix, though, has established itself as a household name worldwide. So, even though I think it may be better to remain on the sidelines given the current environment, which high multiple tech names continue to experience a correction as investors weigh multiple interest rate hikes this year, a further drop would make Netflix attractive for a buy and hold investor. Maybe. So there's some thoughts on Netflix. I think the big hit in Amazon and Disney today were overblown and overdone because those two companies are completely way more diversified than Netflix is. And even though Netflix is, well, one of the reasons they gave for such poor results with subscribers, and they're spending billions on content. But so is Disney, Amazon, they're spending a bunch. What about Apple Plus, Apple TV? There is just so many streaming services right now that, quite frankly, I think people are getting a bit burnt out. Okay. So just some thoughts there on Netflix. Um, a, a lot of different articles I read today where Netflix is being dethroned and it's being kicked out of the thing. I don't know. At some point, and we just got to realize this. We maybe you understand this, but at some point, these subscription services, they are going to reach a ceiling where everybody with an internet connection, especially in the US, knows about Netflix. And if they're going to sign up for Netflix, then they've probably already done so. I think in the quote streaming wars, we're going to see consolidation, right? We've seen all of these. I mean, every single network is either launching their own streaming service or planning to launch their own streaming service. And the whole reason we had streaming services to begin with, it started a whole movement of cut the cord because it was going to cost less and you weren't locked into long contracts. So I think what we'll probably start seeing is more people are going to sign up for a streaming service, watch what they want in a month, and then cut the streaming service. And then in a couple months, when maybe that streaming service launches something new that they want to watch, they'll sign up for another month of it. So I think the streaming numbers are going to start fluctuating wildly because as consumers, we can't have 15 different streaming services to watch what we want. So the smart thing to do as a consumer, pay for Netflix for January, watch everything that you want during that month, then cancel it or put it on hold as some of the streaming services let you do. Like Hulu lets you do that. Maybe you sign up for Disney for a month so you can watch, I don't know, Falcon and Winter Soldier or the Loki series, right? And then you cancel it. Well, I think Disney has gotten a little smart to that behavior from consumers because Disney isn't releasing, and I know Netflix has done this before too, but instead of just releasing it all in one day, Disney is releasing it, one episode a week, like it was when I was growing up as a kid, when you went to watch a series on TV. One episode a week, but they start it and end it, so you have to end up paying for at least 2 months to be able to watch uh, the whole season as it's happening, or just wait till the season finale and then sign up, binge watch it, pay for 1 month, and then cancel it when you're done. And then in, I don't know, in a few months, when the new Game of Thrones series comes out on HBO Max, you sign up for a month of that, you watch it, and then you cancel. I think that's what consumers are going to start doing more and more of, because it makes sense to do that. So then what are the corporations going to do? Well, then the corporations are going to see this habit that consumers are doing, and then they're going to, you got to sign up for at least 6 months. Instead of having a monthly contract, they're going to push it to, you got to have a 2-month contract. And then we're going to circle right back around to being in a cable-like situation. I can totally see it unfolding. All right, that's enough ranting on Netflix there and streaming in general. Oh, sorry, Devin. I went on such a rant. I didn't even. I'm sorry. No need to deep dive, but SoFi's charter bump seems to have been quelled in the madness. I think I'm going to have to wait for it to show up in earnings later this year. I think Netflix may be close to saturation. Yes, I believe that on Netflix. When Netflix stops letting me share my account with my brother, 2 friends, and my neighbor, they'll have to move forward. That's good. All right, SoFi. Yeah. All right. SoFi got a bump because of the approval for their acquisition to become a national bank. Now, the problem here is the overall environment that we're in. Since SoFi is a growth company, and since SoFi is popular with retail investors, right? I think because we're in a risk off, we're in a, I think we're going to go into a whole market correction, like in December of 2018, that growth stocks like SoFi, they're going to get hurt bad. Even, and this is something I said in the deep dive about it, the risk reward ratio for SoFi has never looked better than it does right now. The addition of the bank charter, it changes SoFi fundamentally, at a fundamental level, in a positive way, in a very positive way. That SoFi is going to be able to rapidly expand. Think about, and I don't, when I read different articles on SoFi and the bank merger, what I'm not seeing is SoFi is making an acquisition to get this bank charter. And it's costing them $750 million. Plus the process of going through it. But they're paying $750 million to make an acquisition of a bank. And they're going to integrate SoFi's technology with the acquisition of the bank's technology and digital presence. And then here's the part I don't hear talked about. The customers that the bank they are buying already have are going to now become SoFi's customers. And the verticals for SoFi, it's got a deep bench. And if the bank has a checking customer, well, once it's swapped to SoFi, that checking customer, maybe that checking customer also now becomes a SoFi investor. Maybe. But the customer base that is being added to SoFi when this transaction is completed, and SoFi said that it should be completed February 2022, so just next month. Those customers are going to instantly boost the revenue, the earnings for SoFi. So this, to me, the risk reward ratio, I'm not sure there's another company out there that has such a positive risk reward ratio. This is a fundamental change to the company for the better that will have an instant improvement on the company. And I really think people are missing this one. I think they're missing it. I can remember buying businesses in the past. And, maybe you're starting a new business, and the way you're going to go about doing it is you're going to buy a business from somebody in the space, right? Well, when you buy that company, then you're also buying that customer list. And sometimes there are certain conditions that have to be met, like maybe 90% of the customers uh, must stay customers. Maybe you pay 50% up front and you pay the other 50% if 90% of the customers stay on board in the transition. So there's different conditions that you can set when you're buying a company. But you're going then from zero to, say that company brings in $1 million. You're going from zero to $1 million in revenue just like that because you're buying that company. I think people are missing it. SoFi is buying a company to get this bank charter. And there's real revenue, there's real earnings with that company that come along with this. So, I thought it was for overall. I thought SoFi was taking over the digital business, the 3 branches, and getting it all. Uh, There, I'll double check. I could be wrong. I'm still looking. Let's see here. SoFi. Let's. Oh, here we go. This one might be. This is the OCC and their conditional approval. Okay, so all right, so the OCC gives conditional approval for SoFi to become a bank. The OCC is restricted the bank from crypto activity for the first what is this? Okay, so what it says here, part of the OCC's, and that's the Office of the Comptroller of the Currency, restricted the bank once it's up and running from engaging in crypto assets, activities, or services unless the regulator first gives notice of non-objection. Let's see here. That's interesting that I hadn't read that before, that they're limiting SoFi's crypto activity or putting a limit on their crypto activity for the actual bank itself. Let's see here. Okay, so, all right. This is what I don't think people are clear on it, so I think it's coming off as confusing. So this is from bankingdrive.com. SoFi gets OCC's conditional approval to become a bank. Now, in this article, they talk about a restriction on crypto activity for the bank part of this deal. So it doesn't affect SoFi investing. Let's see. Today's decision brings SoFi, a large fintech, inside the federal bank regulatory perimeter, where it will be subject to comprehensive supervision and the full bank regulations. Okay. Adding that the limit on crypto is consistent with the comprehensive legal and policy review of pending licensing decisions I initiated last May. The move levels the playing field and will ensure that SoFi's deposit and lending activities are conducted safely and soundly. This isn't the first time the OCC has given SoFi a go ahead on a charter. The agency conditionally approved the fintech's previous de novo application in October of 2020, but SoFi's March 2021 agreement to buy Golden Pacific Bancorp, a three-branch, $150 million asset community bank for $22.3 million, allowed the fintech to switch to a change in bank control application, hastening the charter process. SoFi said Tuesday it expects the Golden Pacific acquisition to close next month, which would be February of 2022. Golden Pacific and its branches will operate as a community banking division of SoFi Bank under the deal. So I'm taking this. SoFi is getting the bank, its assets, and everything. This is an incredible milestone. Elevates our ability to help even more people get right with their money. Yeah, that's their solution slogan. And realize their ambitions. Yep, got that. That's just all from the press release. He expects the company will be able to lend. Yeah, that was all talked about. The OCC's other conditions: SoFi must have initiated paid capital of 750 million before the bank launches. So SoFi needs to have 750 million in capital before the bank can launch. So that $750 million isn't to buy the bank. They need to have $750 million as capital, as a secured loan in very simple terms, to operate and launch the bank. But they are paying just over 22 million for the bank itself and all the assets the bank has. The company said last year it would put the amount towards SoFi Bank's nationwide digital banking strategy. Okay, SoFi has also applied to become a bank holding company overseen by the Federal Reserve. Isn't the 750 just 22 million for the bank, 750 to fund it? Yep, absolutely. That's what I'm getting from all the pieces to this puzzle. 22 million for the bank, its physical branches, its digital operation, its customers, everything. And then 750 million to operate the bank. 22.3 million. And it was a change in bank control application. So I'm taking this as SoFi is taking over 100% control. They are buying out Golden Pacific Bancorp, just like Microsoft is buying Activation Blizzard and doing a takeover of that company. Which I think is awesome. I think is great for SoFi. And when you're Googling around on the internet, I'm not seeing people talk about the assets from Golden Pacific. I know it's not a huge bank. I mean, you're paying $22.3 million for it, so it's not huge, but it is something. I should look up Golden Pacific Bancorp assets and see what type of assets they have. So just typing a simple Google search, and it says $134 million in assets. Net income of 333,000 in 2019. Most of Global Pacific's donations. Oh, is this not the right thing? No, it is Sacramento Independent Bank. So Google says 134 million in assets. When does this have a date? All right. So yeah, I think we're on the same page, Devin. All right. Well, that's all that I wanted to talk about today. Close that out. All right. Well, if there's anything else you guys want to talk about, we can do so. If not, we're good. But it does look like SoFi is getting 100% control of Golden Pacific. They're paying $22.3 million for it. It looks like they've got $134 million in assets, the bank. That all gets transferred over to SoFi, and SoFi will have control of that. And then SoFi is putting up for the OCC $750 million in order to operate the bank. So you are welcome, Devin. That's what we're here to do. And that's why I wanted to look. I didn't want to be out here on the internet giving out false information. So I wanted to make sure I double check that, and I always like to do my best to fact check. I don't just look at one source. I try to dig down and find the originator of any type of news. That's why, but I guess it was a few live streams ago. One of the most basic things that we can do as investors to find information when we're putting together our investment thesis is just go directly to the company. Just type in the company's name, investor relations, and every company that is a publicly traded company has an investors relation page like SoFi. And I don't even have to type the I, and it's already popping up because I do it so often. Investor relations, and sometimes there's an ad up top for the company, but usually the very first non-ad link will take you directly to the company's investor relation page, where all the information that you're looking for in the company is there. Overview, news, events, stock information, financials, most important stuff, right? Do you think the tech selling is done or more to come? There's more to come. There is more to come. So if we look at, I want to go here. If we look at the Nasdaq, this is what the Nasdaq looks like right now, which is the tech sector, right? It's been running pretty steady with the S&P 500, using the 50-day moving average as support on the way up, but that has broken. And right now, the tech sector is from the top of that one. Oh, I didn't quite get the top of it. I want to be accurate here. I'm going to go all the way. Oh, yeah, I should use this because this was. No, I'll go here. All right, so January 3rd. I want to make sure I get this top down to where we are right now is a 16% drop, okay? Remember that 2018, the Nasdaq pulled back 20% in that correction. So we could have another 4% to go. Maybe maybe on Monday, and then maybe sometime next week we get a real bounce. Maybe not, because there were a lot of growth companies, there were a lot of technology companies. Their growth stories got really blown up. I mean, really expanded. The valuations went sky high for a lot of these companies. I mean, think about the valuation of Tesla. So a lot of these growth companies, their growth stories just got played and played and played, and it's been playing for so long now that it's like a song stuck in our head. The valuations have gotten really big and out of control. That's why the Nasdaq is being hurt the worst, because the Nasdaq has more out of control valuations than the Dow or the S&P 500. So I think there is more pain to come in the Nasdaq, in tech stocks. This is just the beginning. So build up cash on the side, hold on to it. You don't want to buy too early. Okay. We can't time the market. So just take little nibbles here. Instead of buying 10 shares at a time, buy 3 or 4 shares at a time as it's going down, right? You'll lower your cost basis along the way. That's the best way to handle a falling market. What's a good entry point for Tesla? Man, a good entry point for Tesla. You have to look at Tesla as a decade-long investment, okay? You got to hold it for at least 10 years. Investing in Tesla. Because right now, at its current valuation of $947 billion, almost $1 trillion valuation, you're going to need a decade of time before Tesla can fill those shoes. But I think Tesla will fill those shoes. For me, a good entry point for Tesla, it's got to be at least in the 800s, at minimum in the 800s. But as long as you're looking at Tesla as a decade-long investment, you're going to buy and you're going to hold for 10 years, and you're going to continue to buy every month a little bit, but you're going to continue to buy along the way, then any entry point really is good, right? So Tesla is down 21.9% in the past 17 days. So far this year, it is down 10.6%. But it's down 21.9% in the past 17 days. So that's a pretty steep discount. But for Tesla, though, it's got to come on down a little bit more than this, because it really went on a run. I mean, look at this run that it took from October. From October all the way up to that all-time high in November. That month of October was a huge rally. And you got to fill in the gaps, right? So you see this gap right here, October 22nd, October 26th. This gap right here, it will be filled in as Tesla's coming back down. So that hole will probably be filled in on Monday. But I think Tesla down here under 885, to me, that would be a good entry point. Getting back down to this trend line right here, that would be a good entry point. And this trend line, if we go out a couple days, that's right about 874. It gets us on this trend line if we go out to the 1st of February. So give it another week or so, and then we're out there to February 1st. That's where I would be looking. I bought too early. I went full Willy Wonka kid. Great job jumping in the pool. Yeah. Unless I'm trading, see, you got to have two hats. You got your investor hat, you got your trader hat, and depending on which one that you're wearing, that will guide your decisions that you're making, because they're different decisions. If you're investing for a decade, like that's what I'm doing for Tesla. I don't trade Tesla. I only buy to hold for the long term with Tesla. So buying at, even $943, $37, where it is right now, is fine, because I'm holding it for 10 plus years. But if you're trading, then you want to pay a little closer attention, and you want to get in at a more fair price. And for me, that's down at least in the 800s. Below 885 would really be, I think, the starting point for entering. Okay, Zscaler looking good here. Okay, let's look at that. I haven't looked at Zscaler in a while. Let's see. How far has Zscaler fallen? Well, pretty good. It's under that 200-day moving average, well out of that trading range, but it's still in that gap. Remember this gap that we made right here a while ago? Uh, we've got this bottom here at 238. What was the top? 261. So it's hanging in that range, and it's been, let's see, January the 5th is when it first got in here. So it's now been in here for uh 2 solid weeks. It's been inside this range. So if we go from the top here to where it is now, what kind of, that's a 35% pullback right there. I still think it could probably go further because this market right now, I don't know. Maybe there's another solid day of red coming on Monday. Maybe we get a bounce on Monday. I just don't see it yet though. The signals are just looking too bearish right now. But it is at least a good sign that Zscaler is holding on to this 200-day moving average, and it's staying in this range. At least it's been in there for a solid 2 weeks now. It could totally fall out, but 238 is the bottom of that range, and if it breaks that, well, then it's probably coming down to 220 would be the next area where there could be some support. 217 to 220. But yeah, there's these. Okay. CrowdStrike. Yeah, it's falling good. Let's see here. How far is it down? Look at that. CrowdStrike is down 44.8%. Call that 45%. And it has definitely fallen past these lines that we made. But it is interesting. It did try to bounce here in this support area. And then it turned that bottom support, it tried to hug it right around the 175, but today things just fell so hard today. 5.2% for CrowdStrike. Let's see here. See, this was a good area. 175 being the bottom. That was a really strong area, and we had that really nice bounce there, and it really tried to hold it, but it was just too much today. So now, oh goodness gracious, now if we're looking for any area of support, we're probably gotta go down to 140 before we find another area of support. So yeah, I'm gonna put a line here at 140 because that would be the next area of support, and that range probably one. What would this be right here? This is a good area. There's a lot of points there. 128 to 140. That range there. There's some good support in that area. So that would probably be the next leg down. If there were, I mean, it's already down 45%. That's a pretty good discount. So with it being that far, cybersecurity was a big story for last year with all the hacks that we had. So cybersecurity companies, they really ran up. But yeah, I'd probably start dollar cost averaging from here. But it looks like the next area is 128 to 140. Let's see, CrowdStrike as well. Okay. Cloud security stocks are looking cheap here. They are. Let's see. All right. So if we let me just give me a quick second. I'm gonna look at this. Okay. All right. Just looking at the financials here. To see how the values have changed. So let's see here. Price to sales ratio for the past trailing 12 months is 30.8. Price to cash flow 73. Okay. All right. So yeah, that's where I think it could go. All right, we'll go look over there too. Look at that. Wow. If we were in the typical environment that we were in 2021, it would have bounced right off of this 200-day moving average like it did these past 3 times. But now that it's fallen, where is support here? So it looks like right where it's at that $21, that would probably be the top there of support. So I'm going to put a line there. And then to get a little bit of a range here, then we're coming down to this next area right here, right before that gap of 1960. So that's an area of support right there. So it looks like $22 down to $19. That would be a range of support as it's coming down. But again, if this is a company that you believe in, you think this company is doing a good job, it's got a future, you're looking for the bounce on this, I would be dollar cost averaging in just a little bit. You know, if you normally buy 5 shares, buy 1 share, 2 shares. Just don't do it all at once, because nobody can time the bottom. I mean, we can get close with technical analysis, but still, there's another area of support here. It's not as strong, but it's right here at this 1675, 1650. There was a gap up there, and this is the bottom of that gap, because all gaps get filled back in, and this gap got filled back in, and there was a good bounce here off of that fall at 1650, 1675. That's also real close to where this 200-day moving average is for this purple circle to the left. So that's where I see Marathon Digital at. All right, any other questions? If not, I'll wrap it up here. But if you have a question, plug it in. I'll look at it. And let me just check in on Bitcoin right quick before I wrap it up. $36.6, so it's holding here. It's holding. Let's go look at this at 5-minute level. Got a bounce right there on that 35,000 and what? 35,500. 35,400. So we got a bounce right in between there. And it looks like it's trying to hold. 36.6. I think this is definitely, if you're stacking up on Bitcoin, this is definitely want to be buying some here. Because Bitcoin will not be staying at these levels forever. All right. See, with if Bitcoin is continuing to show weakness over the weekend, then these mining companies they're going to take a big hit on Monday. A really big hit. But if crypto bounces back over the weekend, then the mining companies won't fall so hard on Monday. And right now, when you look at the data, the on-chain data, miners are holding their coins right now. They are not selling their coins. They are not going into the market. All right, so here's one right here. right about $5.80 as a top there. And then the bottom of this, is probably right around the $5 area. So that's the next range there. $5 up to 5. What was this? Up to 5.90. And then if it goes further than that, then it's going down to the $3, because that would be the next area. It's about 360. That would be your next spot. So if you're dollar cost averaging on the way down, which that's what I would recommend doing, so that way you don't buy all at once. There's support right here at the 200 day moving average. There was support here, and it held. The first day would have been December the 13th, all the way until January 5th. It held on that line. So you think, oh yeah, there's good support here. It is holding. Now we need to see the reversal and the bounce. And if you put all your money here at this support level of $7.75, now you'd be in the red because you're down. When a company is building, when a stock is building a base along a certain price point, dollar cost averaging is so important. And that's why when you get new people signing up for Coinbase always says to dollar cost average, because that's the really, it's a secret that's not a secret in investing that more people need to utilize. So with this, we've got a support area here, at 775. We've got support down here at 580 to $5. So you buy a few shares here. Then as it's falling, when it gets to your next area of support, you buy a few more shares. If it falls some more to the next area of support, buy a few more shares. Just make sure that you're dollar cost averaging. All right, so there's Hut 8 mining for you, Mario. All right. So I'll go ahead and wrap it up here. Unless you got anything else you want to go over, I'm happy to do so. Watch for Sunday evening Catalyst Watch video. I know in a market like this, it is very important to know where are the best places to try to get any return. When everything's red, it's like, oh man, this stock is green today. How come I didn't know about this stock earlier? Oh, this stock is green today. Why didn't I know about that earlier? I've already missed out on its rally. It ran this morning. So just having a little guidance on good, solid, researched companies, it's important. And our Catalyst Watch video on Sunday, it's one of those videos. And our top 10 stocks list, it's also one of those things that is just, in my view, and I know I'm biased towards it, but It's one of the best things to have. If you know where to look, then you'll know what stocks to look at too. And it's just a guide. It's a well-researched guide for investors. And our top 10 list is broken into value stocks, growth, dividend, and momentum, and our methods for coming up with those stocks aren't your typical methods. Like our dividend stocks. I put a video out talking about a couple of the key points that we look at when we're finding dividend stocks, and it's not your typical way to find a dividend stock. In my view, it's better. It gives you greater odds of finding a company that's going to hold steady while the market falls and also pay you a dividend. So, in my view, it's the most important guide an investor can have. And first link in the description takes you right there. Become a member, get instant access to those top 10. So, if you haven't already, I would suggest doing so, especially in a market like this. So, Mario, you are welcome. Thank you. You guys have a good weekend, ladies and gentlemen. And I'll definitely see you on Sunday. And I hope to have a couple videos come out over the weekend too. No live streams, but I'll do a live stream Sunday evening for the Catalyst Watch video. So, ladies and gentlemen, thank you so much for being with me today. And I will see you in the next video.